Check this out. These are dividend checks. These are a bunch of checks I got in the mail recently. Hey everyone, this is Ian from ppcian.com. I'm back with another video about dividend investing. Today I want to address the hypothetical situation if I personally had $10,000 and I was starting over, starting fresh, what I would do with the $10,000 in the stock market, where I would place it, what my strategy would be, all of that good stuff. I recently did two videos, one about the same scenario with $1,000, one about the same scenario with $5,000. If you want to check those out, I'm going to link to them in the description below. They're really good videos, and I hope you enjoy them, and I actually think they would be great to watch because today's video builds on those. Before I get started today, I want to share with you something really neat. Check this out. These are dividend checks. These are a bunch of checks I got in the mail recently. Well, some of them are checks, some of them are reinvested dividends, and the fact of the matter is this is why I do it. This is why I invest for dividends and cash flow, because dividends are real money, real cash that one receives in a check or gets deposited directly into their account. And the beauty of dividend growth investing is one can pay bills with dividends. I choose not to pay my bills with dividends now because I want to reinvest the dividends for the long run, but one day when I'm financially free and my dividends cover my living expenses, I will be paying my bills with dividends, which are real money, and I won't have to sell any stock. I won't have to take capital gains. I won't have to sell the principal. I will simply use dividends, and that's why I believe dividend growth investing is a superior strategy to other strategies out there in the market. So let's start with today's question. So the question for today is all about $10,000. And I am not going to repeat my $1,000 video, my $5,000 video, so I'm going to build today. And I'm going to highlight the key differences between those strategies and the $10,000 strategy. And there are many similarities, so I really want to highlight the specific differences. So let me check my notes here. I spent some time jotting down a few notes. First and foremost, what I would do is I would buy 4 stocks. I would buy $2,500 in each. And I would buy the exact same 3 stocks I would do with $5,000, plus I'd add another. The first 3 stocks I would buy are a consumer non-cyclical company in the food and beverage industry. I would buy a consumer non-cyclical in the basic needs industry, things such as like diapers and hairspray and shampoo and razors, batteries, those kinds of things. I would buy 1 stock in the healthcare, medical care, pharmaceutical, medical devices industry. Everyone needs healthcare. Population is growing. Worldwide population is growing. Population is aging. Innovations are coming through. Everyone wants to take good care of their health. These are the industries that everyone always needs. They're around forever. They will be around forever. Basic needs. Great for a dividend investor because it's predictable that these same industries and the best companies in those industries will be around 30 years from now or even more. Now, $10,000, I'd buy a 4th stock as well because I have more money. And so the 4th stock that I would buy is something, an industrial, basically an industrial company. And so this would be a company that makes industrial parts and equipment. They could make airplane parts, they could make heating, HVAC parts, equipment, they could make elevators, they could make anything. They could make anything related to industry, heavy equipment, tractors, that type of stuff. So I would look at an industrial company that's been around forever, that does really well, has a history of growing its dividends, and I'd add that to the mix. So that's what I would do. I'd start with those 4 stocks. 2 consumer non-cyclicals, 1 in food and beverage, 1 in basic needs, a medical company, and an industrial company. I think that would be a really well-rounded portfolio for $10,000. Get exposure to a lot of different things while sticking with the tried and true industries that are very predictable and likely to be around forever. What else would I do? I would go with dividend reinvestment plans. Talked about this at length on my channel, so I don't want to spend too much time here today, but I'm a dividend investor. I'm all about compound interest. I want to live off my dividends one day, as not only want to, I will live off my dividends one day. And so I would like to get these in dividend reinvestment plans, which are a great way to invest for smaller and larger investors. And so someone with 10,000 great candidate for dividend reinvestment plans. You can dollar cost average in, you can reinvest the dividends, buy fractional shares. Fees are low, but you have to check the fees to make sure that they're low, because some of them are not, many of them are. And they're great plans. And so I would try to buy all 4 in dividend reinvestment plans. If you want to learn more about dividend reinvestment plans, I'll link below to a video about that as well. But check out my $1,000 video, $5,000. It's covered at length in there. Now, one thing to note here is when you're buying 4 stocks, it may be that 1 or 2 of them does not have a good dividend reinvestment plan. Maybe there's no plan, or maybe the plan carries very high fees, or maybe not very high, but fees. You just don't like them. I, in this situation, would feel very comfortable complementing my dividend reinvestment plans with a stockbroker, and a broker that had low commissions and dividend reinvestment, hopefully free dividend reinvestment. That's what I would target. And so a mixture of dividend reinvestment plans and stockbroker here would work just fine for me. I'd prefer to have them all in drips with a $10,000 portfolio, but especially because the income that's generated, it's going to be good in the beginning years, but not good enough necessarily to buy full shares. It's only going to buy you fractional shares. And so a drip, the beauty is, let's say you get a $50 dividend, share price is at $100, you can buy half a share. In a lot of stockbroker accounts and a lot of other platforms, you may have to wait until you have enough to buy a full share to reinvest. And so that's one of the reasons I really like dividend reinvestment plans. So what else would I do? I would stagger them. 10,000, I would hate to put it all in the market and then have the market go down overnight. So I'd get 2,500 working for me right away, put 2,500 a month out, 2,500 2 months out, last 2,500 3 months out. So I'd stagger this over a 4-month period. What else would I do? Here's where it gets interesting. When you invest $10,000, even at a starting yield of about 3%, you're going to see good dividend income overnight. You're going to see $300 a year. That's good money that can be used to buy a lot of stuff. There's going to be a temptation here that was not here with a $5,000 or a $1,000 portfolio. There's going to be a temptation to spend those dividends. So I would just be ironclad on my conviction to reinvest those dividends and not to spend them, because that's how the portfolio is going to grow over time. With a $10,000 portfolio, this is very important to keep in mind. Your current income is going to be good. It's going to be a lot better 30 years from now, but it's going to be good, and so there's going to be a temptation there to use those dividends, and I would avoid that temptation at all costs. What else? I would have a cash buffer, so this is something else different. $10,000 is a lot of money. When you're investing $10,000 and you have that kind of money, have a cash buffer in case something happens at work, in case an unexpected bill comes up. You don't want to have to cut into your portfolio. You don't want to have to sell stock to make up for living expenses. You want to have a cash buffer. Now, with a $1,000 portfolio or a $5,000 portfolio, those are smaller amounts, and so I think it's always important to have a cash buffer, but I don't really think about the concept as much as it pertains to those two situations. But with $10,000, it's going to be enticing to tap in not only to the dividends, but the principal. That's a lot of money. You're going to be enticed at times, hey, can I sell that stock? I got to pay for this. I got to buy that. It's going to be temptations out there. And so that's why with a $10,000 portfolio, I'd consciously have some kind of cash buffer. And maybe it means that you can't put in all 10,000. Maybe it means you're going to put in 8,000 and keep 2,000 in cash. I think that is a reasonable strategy if that's the only way that one could have the cash buffer. So this is going to be really important with a $10,000 portfolio, is the cash buffer. I would make periodic auto investments, talk about this at length in other videos, but once I own those 4 stocks, I would selectively add to them over time as much as I could afford, and I'd try even to automate some of those purchases through my dividend reinvestment plans, dollar cost average in. This means buying small amounts each month. This is why I love dividend reinvestment plans and discount brokers also that offer similar tools, because it makes it easier for small investors, big investors to average in over time, to get their money working for them as soon as possible, and oftentimes to pay themselves first. So again, talk about this at length in other videos, so I'm just going to gloss over that point, but I would do it. Is the key here is 10,000 isn't the end all be all, it's the starting point. Keep adding more over time. Keep getting more cash flow. Here's a difference between the $5,000 and $1,000 video. With $10,000, I would mainly buy blue chips, but I would diversify by market cap. If I'm only buying one stock in the $1,000 case or three stocks in the $5,000 case, I'm mainly going with the mega cap blue chips. Buying four stocks in this case, I got more money working for me, I would diversify. I wouldn't really buy mid or small caps in this situation, but I would probably buy some mega caps and some kind of mid-level large caps as well. So maybe I'd buy a stock that has a $10 billion market cap. Maybe I'd buy one that has a $20 or $30 billion market cap. Maybe I'd buy one that has a $60 billion market cap. Maybe I'd buy one that has a $200 billion market cap. I try to diversify by market cap. I'd make this a little bit more conscious than I would have with those other cases, because in the other two cases, I was thinking more just about mega large cap blue chips because I'm so focused on the positions. In this case, I have a little more freedom because I have more positions, more money. Another difference, in the other videos, since I'm only targeting one position or three positions, I would target the companies that grew the dividend 7% year over year forever. And this is important because it creates a great yield on cost. In this case, I'm in four stocks. It's going to be harder to find stocks that have a consistent track record of 7% per year over the long term. I would look more in the 5 to 7% range, maybe dip as low as 4%. The key here is to buy the stocks that grow the dividend over time, because this is called dividend growth investing. I'm investing in companies that grow the dividend over time. The reason I'm doing that is the starting yield doesn't matter. The yield on cost is what matters. One day, if they've grown the dividend enough, I could be yielding 20+% on my initial purchase, and I'm actually going to show you that in a minute. And so it's important to have the stocks that grow it each year, grow it consistently. 7% might be a little bit aggressive for $10,000 portfolio, so I'd be okay anywhere between 4 and 7%. I would also look for current yields in the 2 to 3% range. It's going to be a little harder when you're picking four stocks to pick all 3% plus yielders or 3% yielders for starting yield. So I'd be just a little bit more lenient in the 2 to 3% range on a starting current yield. And again, the current yield isn't what matters. It's the long-term yield on cost. So let's look at some numbers. 30 years out, let's just say you got that 3% starting yield. Let's say you got dividend growth of 7% per year in perpetuity. You're going to yield 23% on cost. You're investing $10,000, you wait 30 years. I'm not even looking at capital appreciation. I'm not even looking at reinvested dividends. I'm modeling conservatively, or very conservatively in my opinion. Just by modeling conservatively, though, it shows the power of dividend growth investing. 23% yield on cost. That means $2,300 per year for the rest of my life, assuming they don't even raise the dividend more. That is real money that can pay real bills, dividend checks. Now, if I choose to reinvest the dividends, which I would, if I look at the capital appreciation, which I would, the gains are even better. So my name is Ian Lopuk. I'm from ppcian.com. This is my video on what I would do, hypothetically, if I had $10,000 and I was starting over in dividend growth investing. If you enjoy this video, I please ask you to like, to subscribe, to comment. All of that means the world to me. It is the greatest compliment you can give me. The more subscriptions I get, the more likes. It encourages me to produce even more videos here on the PPC Ian YouTube channel. Now, as a friendly disclaimer before I leave, today's video is just for your fun and entertainment. I am not a licensed investment advisor. This is not investment advice. This is just for fun and entertainment. If you are going to go out and invest, please consult a licensed financial advisor first. Also, please note that today's video is not tax advice either, and I'm not a tax advisor. Thank you so much for watching. I will see you in the next dividend investing video.